China's $130 trillion market just got built out and it made a record gain in the last 30 days. In the last 1 month, we actually saw a 30% increase in their index. 30% gain in 1 month for the second largest market like China is absolutely mind-boggling, especially given the Great Recession they just had in the last 3 years. And this is all due to China's government's great effort in restructuring their debt and incentivizing economic activities. If you do remember, from 2021 to 2024, the property market actually fell by 10%, with their stock market falling by 30%. And just a quick summary for those of you who do not remember the story, China was in a state of a bubble so bad that 70% of the whole country's wealth was in real estate, twice as high as in the US. And all the signs of an inevitable economic collapse was there. And Ray Dalio, the founder of the world's largest hedge fund, has talked about these signs from his system that predicted all the economic collapses. For example, in China, people were speculating by pre-selling units, and buyers would even buy before the properties even existed. And the property price to income ratio was 23, meaning it would take an average person 23 years to buy a property outright. And the debt to GDP ratio was 300%, 3 times their country's GDP. And these speculations have led developers to overbuild, resulting in a surge of supplies, and a lot of them were very low quality real estate buildings, totaling 60 million vacant apartments overall. With these signs, it's really easy to see how everything was bound to fail. This, combined with China's zero COVID policy, where there were strict lockdowns and travel restrictions affecting businesses, and governments imposing debt limit for developers, really kickstarted the whole crash. For example, Evergrande, China's second biggest developer, had $300 billion in debt and a debt-to-equity ratio of 6.4 in 2021 before it declared bankruptcy. A DE of 6.4 means the company had more than 6 times its equity in debt, and they were using this debt to finance projects through pre-sales and extensive borrowing, promising high returns. But of course, just like any strategy that focuses on excessive debt and promising high return, they only work if property prices do not slow down. And of course, with every story, property prices do slow down. Because at that particular moment, the Chinese government saw how highly leveraged every single property company was, and they started setting strict limits on the amount of debt that developers can take on, which forced Evergrande to reduce its existing leverage drastically. However, you can't tell a company that has a lot of debt to just simply reduce them, because they have to pay them off, and a lot of times companies do not have the money to pay them off. And that's exactly what happened to Evergrande. Evergrande could not reduce its debt since it did not have the cash flow to pay them off. So they started defaulting, and eventually they went bankrupt. And the same happened to many other companies in the last 2 years, until 30 days ago, when we had almost 30% gain for their market in just a matter of 1 month. And this because since 2023, China has printed $1 trillion, and they use this money to smartly restructure the whole country's debt. Now, firstly, they provided more loans to save the banks and incentivized more lending. In December 2023, China's central bank actually injected $50 billion in major banks in the form of low-interest loans. Now, the purpose of this loan is so that the banks can use this loan to lend out to other developers to support their financial situations. Usually, the leverage that these type of solutions have on investments is around 1 to 2.5, meaning the $50 billion could potentially translate to nearly $125 billion in economic activity, meaning growth in construction and banking. Secondly, China's central bank also lowered the bank reserve requirement. By lowering the reserve requirement, the central bank effectively allows commercial banks to hold lower reserves, effectively increasing the money available for lending to businesses and consumers. They cut the requirements by around 0.5%, which released around $140 billion in long-term liquidity into the financial system. Talking about lending, they also cut the interest rates for mortgages to reduce debt burden for current borrowers. For existing mortgages, interest rates were reduced by an average of 0.5% to really align with the rates on the new loans. This policy adjustment is expected to benefit around 50 million households, saving borrowers approximately around $21 billion annually. Lastly, the minimum down payment for second homes was reduced by 25% to 15%, and this was aimed to stimulate the demand in the housing market by making home ownership more affordable. With all these interventions, the result is the recovery of China's market, as you saw in the last 30 days, with 30% gain. And if you've been watching my other videos, you would know that this all falls in the second half of the 18.6-year real estate cycle developed by Fred Harrison that accurately predicted all financial crises using data from the last 200 years. The cycle actually mentioned in there that in the second half of the cycle, which we are in now, emerging markets with big export potential like China tend to do very well. So if you're looking to invest into China, vehicles like ETFs that track China's index or REITs that track their real estate developments are some to look out for. However, although China is in a growth phase, it can lead to oversupply and higher debt risk, which can trigger corrections. The intervention that their government did does have risk. For example, with the lowering of bank reserve requirement, this leaves the bank exposed to risk of bank runs if an economic collapse comes and all people want to withdraw their deposits. Therefore, it's important to monitor economic indicators such as the property price trends, the household debt levels, and government debt to GDP ratios to really gauge potential shifts towards a downturn. Now, this cautious approach will provide flexibility to pivot quickly if the markets actually signal a cycle shift towards a recession. And the reason why you really need to be cautious is because if you don't monitor where you are in the cycle, everything I told you will not work, and you will most likely lose half the money you've made during this run. So do watch this video next where I explain the cycle and corresponding strategies in each stage.